So you're in property and you want to scale your business, but you are struggling to get finance because you have private investor funding. So what is private investor funding? This is when, let's say, a family or a colleague invests in your business or in your project for a fixed return. And so these are private funds. It's like a private loan that you get, but only from a familiar person or a private person that's not a lending institution. Now, it may be difficult to get a mortgage if you get this kind of loans as a deposit, because typically lenders want to make sure that the money is coming from a legal source and that it has been taxed at source. So it is a risk in terms of anti-money laundering, and that's why it's difficult to get lending if you're using private investor finance. So this is not difficult if you're going to purchase the property for cash fully, but if you're going to get a mortgage, it might be difficult. Now, how can you make sure that this is easier for you if you want to get a mortgage in addition to the private investor finance? Now, you can have the private investor finance given to you in your personal capacity, and then you loan the company. That way, checks can be done on you and there is minimized risk. Or if you want to use private funding, you can try and have that come from an intercompany. So what that means is it's another company within the same group of companies. So a company with the same owner giving the funds to your company. That would make it easier for most lenders to accept that form of money, and they can do the background checks as well. What you can do, however, is set up an entity where you are also a director. It can be as a JV, or maybe not a JV in that instance because you're not doing the project in that particular company, but you're setting up a company where funds are being provided by the lender. Then that company, because you're a director in that same company, can now lend to your company. So as long as the directors are the same, so it makes it easier for most lenders to be able to give you that mortgage if you have the same directors. So essentially, it's a very difficult one if you're not buying for cash, but if you're buying using a mortgage, you want to try and make sure that the source is an intercompany or a related party, or perhaps you yourself, rather than a company that is not related to your company entirely, legally anyway. What do you need to have in place to make sure that your agreement stacks? So you want to have a full and a properly documented loan agreement between you and the lender, stating the full terms, specifying the purpose of the money. So if it's for a refurb project or a property project you're working on, it should specify what the funds are being used for. It should also specify what would happen if you defaulted and if you paid late. What are the terms? So fully state the terms. In some instances, you may need to provide the lender with a guarantee to say if you default or if the company defaults, how will the lender retrieve their money? So it can be a second charge to the property, or it can be through insurance, for example. So let's say something happened to the property, the lender is guaranteed that they will get money because they are a named beneficiary on the insurance. So you want to give that guarantee, and that guarantee should be included in your loan agreement as well. So just a couple of things for you to think about as you're getting private funds from people. How are the funds flowing into your business? Have the full checks been done? Have you documented it properly in terms of the agreement, the guarantees, the warranties that go with that? Have a solicitor check your documentation to make sure that it stacks as a valid loan agreement.